A client of mine, a dentist with two practices doing everything right, called me after getting a notice from the IRS. She had a great CPA. She's been filing clean returns for years. She had real deduction, legitimate strategies, and a tax position her advisor had specifically recommended. Her first words to me were, I don't understand. I followed the rules. And she did. Every single one of them. That's not what the problem was. The problem was that when the IRS asked her to prove it, she couldn't. And that gap between what's legal and what's provable cost her more than $60,000 before it was over. Think of it like this. Your patient comes in with abdominal pain and you order CT and it shows a finding that clearly warrants surgery. The pathology is real. The clinical indication is obvious to you. But when you submit the prior authorization to the insurance company, they deny it. Not because a condition doesn't exist, because the documentation that you sent didn't clearly establish the medical necessity in the way they required. The imaging was there, the diagnosis was there, but the supporting notes, the failed conservative management, and the symptom timeline, it wasn't packaged the way the insurance company's checklist demanded. That's exactly what happened to her. Except the insurance company was the IRS, and the denied claim was a $60,000 tax deduction. That story is not unusual, unfortunately. I hear a version of it constantly from physicians and dentists who came in as patients and left as my client. My name is Dr. Taxer. I'm an enrolled agent with a master's in taxation, and I work exclusively with physicians and dentists on tax strategy, compliance, and audit defense. So today I want to give you the framework that most advisors never walk you through because understanding how audit actually work is the one thing that genuinely protects you. So three things: how the system finds you, what the IRS actually does when it does, and what real protection looks like. Let's start with how returns actually get selected because most people assume audits are random or that they only happen to people who did something wrong. Neither is true. The IRS uses two primary systems to flag returns. The first one is called DIF score, the discriminant index function. So every return you file gets assigned a confidential score based on historical pattern across millions of returns. Think of it like a risk stratification model. Just as your EMR might flag a patient as high risk based on age, comorbidity, and lab trend, the IRS flags return based on deduction size relative to income, the character of line items, and how your returns compare statistically to others in your tax bracket. The higher the score, the more likely a human reviewer opens your file, decides whether to audit. The second system is called AUR, the Automated Reporting System. This one is more like a lab crossmatch. The IRS receives copies of every 1099 NEC, W 2, third party information return, file under your Social Security number or EIN. If income appears on those documents, but not on your return, even by accident, it triggers a correspondence audit automatically. So, for physicians and dentists, this matters more than most people realize. You may have hospital stipends, speaking fees, research income, consulting arrangement, or ownership distribution across multiple entities. Every one of these income streams that generate a 1099 is being cross referenced. Every mismatch is flagged. And if you're wondering whether you can challenge the IRS reason for selecting your return, you cannot. The tax court decided that question decades ago. In Greenberg's Express versus Commissioner, the court ruled it will not look into why an audit was initiated. The only thing that really matters is whether the resulting tax assessment is correct. So the question isn't whether you can avoid being found. The question is what happens when you are. And here's where most people's understanding of audits break down completely. An IRS audit is not a criminal proceeding. IRS does not build a case against you. They do not have to prove it you did something wrong. You have to prove you did something right. That's the burden of proof. And legally, it sits entirely with you as a taxpayer. Unfortunate. The IRS can identify any deduction on your return and ask one question: can you prove it? And if you cannot substantiate it to their standard, they can just reverse it, even if the deduction is completely lawful. In medicine, you know this dynamic as well. In a malpractice case, the plaintiff has to prove you deviated from the standard of care. But in a payer audit or RAC audit, a Medicare review, the burden flips. The payer doesn't have to prove the service wasn't medically necessary. You have to prove it was. The IRS works exactly the same way. Let me make that concrete with the tax example. So, say that you deducted vehicle expenses last year, a legitimate deduction allowed under a Section 168K bonus depreciation. The IRS asks for your mileage log, and you hand over bank statement and credit card records. From your perspective, that's proof. From the IRS perspective, it's not. Under IRC Section 274, vehicle use, travel, and business gifts are in a special substantiation category. The rule that normally lets taxpayer use reasonable estimate when records are missing, the Cohen rule, does not apply here. Section 274 requires what's called strict substantiation. The amount, the date, the destination, business purpose, and the people involved. Every trip, documentation at the time it occurred, and no contemporaneous mileage log, the IRS may disallow 100% of deduction. Not because the business driving didn't happen, because you can't prove it did. It's the same reason a progress note written 6 months after the visit doesn't hold up in payer dispute. The clinical encounter happened, but the documentation wasn't created contemporaneously, and that's what the review was based on. And now there's a mechanism that can switch the burden back to the IRS. So under Section 7491A2, if you maintain proper records, complied with all substantiation requirements, and fully cooperated with the audit, the IRS must then prove the deficiency in court. So here's what I see in practice. Most taxpayers don't meet that threshold. Even well-intended one, like a med student gunning for a derm residency. So what ends up happening is you did something legal, you didn't document it to the IRS standard, and now you're trying to reconstruct records years later for a government employee who's just following a checklist and has no interest in context behind your return. That's not a system designed to find the truth. It's a system designed to check boxes. And the only way to survive it is to make your return easy to check. So, what actually increases your risk? So, let's talk about what I see most often with physicians and dentists. So, the single biggest trigger is repeated losses with no clear justification. So, anytime your return shows a loss, especially one that offset your W 2 or practice income, it draws attention. The tax code assumes business exists to make a profit. Repeated losses raise a question that the IRS eventually asks out loud. Is this a real business or an expensive hobby with a business label attached to it? Think of it the way you think about a patient with a chronic complaint with consistently normal workups. At some point, you start thinking different question. Is this like a cuckoo patient? The IRS does the same thing when it sees losses year after year. The high risk categories includes Schedule C losses with the side consulting arrangement, real estate professional status claims, which I see frequently in physician households, and large depreciation deduction through cost segregation that effectively wipe out taxable income. Now I want to give you a real case because it illustrates exactly how this plays out. There's a well documented case, Birdsong versus IRS, involving a full time ER physician whose non working spouse managed 9 rental units in Oakland, California, and claimed real estate professional status. IRS didn't believe it. They audited and they challenged the real estate professional status. And after years of headaches, the taxpayer eventually won because the records were there. The time logs existed. The documentation held up in court. That case is an entire lesson in one story. The strategy was illegitimate. The IRS assumed otherwise. But the documentation was airtight. And that's what decided the outcome. So it's the equivalent of going into a peer review hearing with every chart note, every order, every communication documented. The facts don't change, but your ability to defend yourself completely depends on what's in the record. So if you're taking home office deduction, doing cost seg studies, or claiming real estate professional status, as long as you have a clean and airtight paper trail behind it, you're setting yourself up for a win if you get audited. So I've spoken with the former IRS chief counsel attorney about this. Given the staffing shortages the IRS faces, if your documentation is strong, they may move on to returns where it isn't. The audit process has triage system built into it, just like an ER. So let's talk about how audits actually arrive. Most people picture an agent knocking at the door. That's not how usually it happens. So most audits come as a letter. So if there's an income mismatch, you'll get a CP2000, a notice proposing changes. If they need specific documentation, you get a letter 12C. If you don't respond with exactly what they're asking for, they don't negotiate. They just adjust. And now you're the one who has to prove they got it wrong. So, what actually protects you? The first thing I tell every patient, audits are expensive even when you win. Best case, you spend months producing records, responding to notices, providing what you have already reported, and you come out exactly where you started. No refund, no credit, just time and legal fees. Think about what a peer review or license board complaints cost you, even when you are completely cleared. It's not just the legal fees, it's the hours away from your practice and family, and your mental bandwidth and disruptions. An audit works the same way. The outcome isn't the only cost. For a physician or dentist, your billable hours have a real dollar value. A disorganized audit response can run into tens of thousands of dollars before it's resolved. That's why the goal isn't avoiding an audit, it's being built to move through on cleanly when it happens. So foundation of that is real-time documentation, not a year-end catch-up, not a spreadsheet your bookkeeper assembles in December. A system that ties receipt to transaction, records business purpose at the time of the expense, and produces a clean general ledger on demand. You already lived this standard in your clinical work. Meaningful use, MACRA, pair audit, they've all conditioned you to document at the point of care, not after the fact. So your tax records need to work the same way. The IRS does not credit for reconstructed documentation any more than a malpractice attorney gives credit for an amended return. When the IRS asks for your general ledger, and they will, you may want to hand it out over hesitation. That shift from adversarial to administrative is the difference between an audit that costs you nothing and the one that costs you everything. There's one more legal concept that directly affects your exposure, especially with complex income streams. The IRS generally has 3 years from filing date to assess additional tax. But that clock only starts if you filed what courts call a valid return. So, under the Beer test from Beer versus Commissioner, a return is only valid if it contains enough information to calculate tax liability, represent an honest attempt to comply with the law, and is signed under penalties of perjury. File carelessly, omit something significant, and the 3 year window extends to 6 or sometimes disappear entirely if fraud is alleged. For anyone with hospital contracts, multiple 1099 sources, research outcome, or ownership distribution, income matching is not optional. Every information return filed with the IRS under your name or EIN needs to appear on your tax return. The AUR system will find the gap before you do. And finally, this is the one I want you to take with you. A tax strategy that lives only in your advisor's presentation is not a plan. It's a liability. Real planning means the right strategy paired with the right documentation, the right entity structure, right election file, and the real system in place before anything hits your return. If your advisor gave you good ideas, but you don't have the records, written policies, or contemporaneously log, you're not protected. You're just positioned to lose a deduction you're entitled to. In medicine, informed consent isn't something you describe to the patient and call it done. It is documented. It is signed. It's in the chart. Tax planning works the same way. The idea is not the protection, the record is. The IRS is a box checking system. Your job is to make those boxes easy to check. And when you do, an audit stops being something you fear and starts being a process you move through and come out exactly where you started. So if you're a physician or dentist with a complex return, multiple income streams, real estate activity, significant deduction, or tax strategies your current advisor recommended but never fully implemented, this is a time to take a real look at your exposure, not after a notice arrives. If this gave you something useful, share it and subscribe. Most of the professionals I work with had never heard this explained in plain terms before, and that gap is exactly what creates expensive problem down the road. I'm Dr. Taxer. I see you in the next one.